Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today, we are running through the March 2025 macro market update. Stay tuned. A couple of data points we will be discussing. But firstly, before we dig into the detail, we'll just do a quick recap on the 18-year land cycle. I've added a couple more reference points to it to give folks a bit more context as the cycle plays out. We use this 18-year land cycle as our framework when investing. It is like an underlying current cycle that has been happening for over 200 years in the UK, the US, and Australia, and now all markets as they become more globally connected. It is also known as the business cycle, and it is key moments in time. It's history. We are on the blue marker. Similar point of time in the prior cycle would be late 2005. So about 18 months away from the next land-driven downturn, which will be like the next GFC-like event, but this one coming may well be just like the 91 recession we had to have, as every second one is a big one. And China is not necessarily as strong as they were, their economy, that is, than they were in 2008-9, where they more or less saved the Australian economy. We pretty much sailed through the GFC compared to other global markets. This time around, China is definitely not as strong, and they have tariffs being applied to them. So their property construction industry isn't as booming as it was nearly 18 years ago. So this time round, potentially the downturn could be significantly more acute than what was experienced in 2008 and 9. But we are on the blue marker. And if we dig a little deeper, historically, Sydney, Melbourne outperform, along with the global markets such as New York, Hong Kong, Beijing, LA. The global markets tend to outperform in the first half of the cycle in the recovery after the land-driven downturn, as they have the most jobs, the most diversified economies. As the cycle plays out, people then decentralize into second-tier markets in their sought out for affordable housing. So that's when we see in Australia, regional Victoria and regional New South Wales having a flow-on effect from the outperforming markets of Sydney and Melbourne, like what happened from around 2015 to 2022. That's when regional VIC and regional New South Wales outperformed, as they flowed on from Sydney, Melbourne, that outperformed from around 2008 and 9 all the way up to 2017. Come mid-cycle, we're then due for the mid-cycle slowdown. This time round, it was known as the COVID recession, but the last mid-cycle slowdown in the prior cycle was also the dot-com bust. It's not as significant as the end of cycle recession. Stock markets do take a 40 to 50% correction, but property typically can stagnate in certain markets and can correct 5 to 10%. But it is a mid-cycle slowdown. Federal governments typically panic, drop interest rates, print a lot of money, just like what they did in 2020. That then sets off the later stage of the cycle in the land boom, where we are now in the tail end of the land boom and entering the final winner's curse phase prior to the market topping out, which is due in 2026. In the second half of the cycle, that's when people then are fed up with the likes of New South Wales and Victoria and head out interstate into the likes of Brisbane, Perth, Adelaide. Those markets then outperform in the later stage, like what we've seen in the last couple of years. Their outperformance 3 to 4 years in, people are then priced out of those markets and then head out into the regions. So then their respective regions, such as South Australia, Queensland, and WA, then outperform towards the end of cycle. Regional Queensland and WA can also have a longer run, even once the land-driven downturn starts to commence, due to their dependency on the mining sector. And during the land-driven downturn, global markets will stimulate their economies by printing money, spending on infrastructure that filters down to the benefit of construction and property industry that draws on the Australian commodities, which sets off our mining sector. They are heating up now, and they are starting to run, and they will potentially continue to run even throughout the next land-driven downturn. So that's when we see the likes of Townsville, Cairns, Toowoomba, Dalby, these regional towns in Queensland and regional WA mining towns can continue to buck the trend. Meanwhile, most of the other markets are starting to slow down. But then once the market does get in its trench of the land-driven downturn come 27, 28, 29, that's when the Brisbane, Perth, Adelaide and the regions will then have a good slowdown for a number of years. And then the ripple effect comes back to the more diversified markets such as Sydney and Melbourne, and then they then will lead again in the recovery. And the next 18-year land cycle will then continue to play out. That's a bit of a summary of where we are. Moving to our next slide, we had the Reserve Bank of Australia maintain the cash rate only yesterday at their board meeting. Key points from the RBA's statement I've got here for you is inflation is moderating. They believe monetary policy remains restrictive. So I guess that can be promising. They still believe they are in a restrictive stance within terms of the cash rate. So that does provide opportunity for further rate cuts in the near future. And there's commentaries more so shifted away now from inflation, and more commentary is now around the uncertainty in relation to the US tariffs. This could be work in both favors. This could either be inflationary, or this could even start straining Australian businesses if we start getting hit with tariffs, such as our steel exports, coal. So if that is the case and unemployment starts to pick up a bit, then we could expect further rate cuts. So that was a bit of a summary snapshot from the RBA, but the RBA decided to hold at 4.1% at this current time. The Australian inflation rate, all groups CPI, is down to 2.4%. There hasn't been as much data released as of yet on the ABS website, so this is still to December 2024. I believe next month will give us a bit more data points, so hopefully inflation continues to trail. But the RBA looks at the trim mean inflation, which is at 3.2%, and they want to see it maintained consistently within the band being 2.5%, the trim mean, until they look to further cut rates. So time will tell, but it is trending in the right direction. Unemployment maintained at 4.1% in February. So this is another key item to watch. Once this starts to run up to 4.5%, 5%, 6%, that's when it'll be a leading indicator that we are entering the next downturn. It is still relatively tight labour market based off historical averages, but it did bottom out around 22, 23 at about 3.5%, and has since been trending slowly up. So definitely one that I like to watch and what the RBA watches as well. And it will probably be around late 26, come 27, where the unemployment rate will start to pick up and potentially hit as high as 7, 8, 9%. But time will tell. But this is definitely something we like to keep an eye on. Also, big key focus is watching what happens in the United States as they lead the 18-year land cycle. Australia typically trails 6 to 12 months behind the US. They have maintained the Federal Reserve interest rate, which is just like the RBA cash rate in Australia, at 4.5%. Jerome Powell also made commentary that he doesn't see in the near term of needing to drop it, as their inflation rate picked up a bit from when they started dropping the cash rate from September up to peaked again in January this year at 3%, has trended down to 2.8%. However, to note, the US has a target of 2%. Unlike Australia, that we have a band, so 2 to 3% band, the US has a target of 2%. So their aim is to maintain inflation under 2%. That's a lot more restrictive, harder to do. So we can expect their rates to stay higher for longer until we do enter the next land-driven downturn, when it will become well evident that we've entered the next slowdown, and or when inflation starts to trend further south. The US unemployment rate picked up by 0.1% in February. In January, it was 4%, so it is starting to trend up slowly. So again, this is another key indicator that we would like to keep an eye on, as historically, when the unemployment rate starts to run high very quickly, then that is a pretty good indicator that we are entering the next downturn. So is slowly starting to come up, but is still pretty tight based off long-term historical averages. Copper price, Dr. Copper also is a phrase used in the investing world. It is used to understand how strong the global markets are, because copper goes into pretty much everything in terms of cars, new houses, home building, construction, electronics, manufacturing, and it is at all-time high levels. So, which is good. If it started to trend south, then that would be a leading indicator that we've started to enter a downturn, but it is still hitting all-time highs as demand is still growing in need for copper. So another thing we like to also keep an eye on. US stock markets has experienced, along with the global markets, a bit of volatility lately due to Trump spooking the markets with his tariffs and his aggressive negotiation tactics when it comes to trying to end these wars. But I believe the markets are stabilizing and will continue to rally this year based off WD Gann decade cycle. Years ending in 5 are historically very bullish years. Take it back to 2015, very bullish year in the markets. 2005, very bullish year. So we can expect 2025 to be also a bullish year. Take it back again to 1985, very bullish year, lead up to 1989 peak. So years ending in 5 are historically very bullish years for the markets. So this slight pullback, I believe, is just a bit of a market being spooked, and it is already showing signs that the recovery is on the way. So come the year end, I believe the US stock markets, the UK stock market's already hitting all-time high, but also the Australian stock market is trending pretty similar pattern to the US stock market, but I believe by the end of 2025, the global stock markets will be again hitting all-time highs. So time will tell, but we also like to keep an eye on the US largest home builders, as their stock prices is still falling, as they are pricing in lower earnings due to slowing land markets in the US. Same thing happened back in 2004, 5, 6. They trended south. Meanwhile, the rest of the markets continue to outperform and do well. And these large home builders, land developers, house and land package type of developers, their share price went south by a good 70, 80% in the background. And it wasn't until October 2007 when the land-driven downturn became well known in the mainstream, when then the overall indexes collapsed. So it's starting, early signs still, but we keep an eye on this very closely. And if this continues to keep trending south, then once these stock prices from peak to trough hit around 60, 70%, that's when we can expect the overall indexes to start to go through a correction. Bitcoin, the Bitcoin gurus have been sweating bullets recently. I think it is starting to stabilize and will continue to boom into 2025 and 26. Come 27, it's anyone's guess, but Bitcoin, in my opinion, is a big Ponzi scheme. There's just more buyers than sellers currently, but when the market starts to turn and land price starts to soften and people find themselves in negative equity and the banks start to margin call and require people to pay down debt, the first thing that they'll be selling is liquid assets, such as their crypto portfolio or stocks. If there's more sellers than buyers in cryptocurrency, call me old-fashioned, but I think it is going to go to zero. Time will tell. It'll be very funny times. Get your popcorn ready, but unfortunately for some people like to tend to rush into the tail end of speculative booms, ultimately get taught the hard way. Only invest in assets that are tangible, such as bricks and mortar, real estate. It's not going anywhere. It'll be here forever. Everyone needs a roof over their head. No one really knows what the Bitcoin blockchain really is. Sounds like too much speculation for my liking. Key takeaways from the federal budget being released that will impact the Australian property market. Firstly, rental assistance, a 10% increase to the maximum rate. Thank you very much, Albo. That'll ultimately get soaked up in higher rents, and the higher rents will then get capitalized into higher prices. If people have more money to spend on rent, they'll spend it on rent. So ultimately that will end up in the hands of the landlords, increasing their rents. With higher rents, that increases their property value. So thank you very much, Albo, for that rental assistance. Second to that, income tax deduction. So again, tax cuts. This is for the lower income earners, but most of their income would go on rent again. So again, this would boost rents. So from July 2026, the tax rate is getting cut to 15% for people on 45 grand and less. And then as of July 2027 is then getting a further cut to 14%. So that modest minor cut will ultimately land in higher earnings for residential real estate. Thirdly, how I see some of these items hitting the Australian property market. 2-year ban on foreign buyers. This is an interesting one because it is counterintuitive to what they are trying to do, because in FY23, foreign buyers purchased approximately 5,360 homes worth 4.9 billion, nearly $5 billion. So now they can't buy. So there'll be about 10 billion worth of real estate that they can't buy. They will be pushed to the rental market. So there will be less rental stock available, as the rental stock is already soaked up with this massive migration program they've been running over the last couple of years of 500,000 people coming in every year, compared to 100 to 150,000 of historical averages. It's soaking up all the rental stock. It's why, we are in a supposed housing crisis. What it really is a demand crisis. So now adding insult into injury, allowing all these migrants to flock into Australia, soak up all the rental stock, and now also banning them from buying any property is going to put even further pressure on the rental market, pushing rents even higher. Those rents will get further capitalized into higher prices, and the property market will continue to keep moving on. So another great one for property investors. Fourth point, housing supply boost, 11 billion invested to support new construction of 1.2 million homes by 2029. I mean, I recently came out of a land developer who was getting funding for this scheme to build to rent stock for new sites in Sydney for nurses, police people, firemen. It is a good scheme to build that stock. Ultimately, I don't see it really impacting the overall market. It's more so providing more supply to those lower income earners or more necessity workers in the capital cities. Whether or not they'll hit 1.2 million homes, very optimistic. I mean, the biggest developer in Australia, Harry Triguboff, he develops typically 2,000 or 3,000 apartments every year, probably maybe a bit more, 3,000 or 4,000 is probably his run rate. So if he can only develop, say, 10 or 15,000 homes in a 5-year window, and he's the biggest guy in the industry, the biggest one doing it, I don't see 1.2 million homes being built in 5 years by the government. It's a bit of a pipe dream, definitely more of a politics play to say that they're doing something, but the first 2 points is not actually helping the situation. Fifth point, help to buy scheme, 800 million provided from the government to pay 40% for new and 30% for established properties for first-time buyers, allowing them to get into the market with as little as 2%. Again, giving people more money will ultimately get soaked up in higher prices, and then you'll end up having the government owning a share of your property. I don't see it really impacting the market too much. I mean, not even $1 billion worth of real estate. We'll give it a bit of a blip. Whether or not it'll help those first home buyers may well do so, but they'll probably end up paying higher prices anyway if they've got more money competing in the marketplace. And a wrap up of nearly 27 billion deficit after many years of being in the black back to back. So great work, Labor. What's going on in the US? Key points for this month would be Trump is starting to ramp up his pressure on Russia to try and end the war. Putin is not playing game. He obviously wants to continue his empire building. So Trump is looking now to apply sanctions on Russian oil and gas, which makes up about 15 to 20% of their GDP. So a pretty significant blow, basically meaning any country in the world that wishes to buy oil and gas off Russia can no longer do business with the United States. So he's pivoting that demand towards the US, so the US can provide that oil supply, oil and gas supply, as he is drilling baby drill, but then also using that as leverage over Putin to try and end the war, because their economy is in a recession, unemployment's high, inflation's high, interest rates through the roof. And if you then start draining their GDP, then he really won't have much money to keep funding the war anyway. So it's leverage, classic leverage he's using, and hopefully it works soon, because I see once these wars get all cleaned up, tidied up, and he declares victory come middle to late this year, hopefully, that will then set off ultimate optimism in the markets, and the markets will be roaring like the roaring 20s. Time will tell. As always, this is by no means financial advice. Not that it is financial advice. This is just general information, my thoughts of what's happening in the markets, how it may impact the Australian market. Stay tuned for a property market update. I will be running a bit more detail around certain markets such as Cairns, Darwin, Townsville, may even throw in Tassie. These markets I don't necessarily always cover. I've been getting a few people hitting me up wanting to know where they sit in terms of the 18-year land cycle. That's soon to come. I'm working on it now. I'll be rolling out in the next day or two. Stay tuned. If you need help, shoot me an email. If you are looking to get into the market and buy an investment grade property, there's always a market and a type of property to buy as the market plays out. So don't be spooked. Real estate is always needed. We are the lucky country. We have a booming population and a construction and property industry that can never keep up with the demand. It is the best industry to be in, to build your wealth, hedge your wealth against inflation, as inflation continues to increase the value of your real estate and will continue to devalue the debt that you use to buy it. It is by far the best asset class to be in times of turbulence. Until next time, thanks for watching. I'll see you on the next one.